There's not a lot of profit growth in their forecasts. So it's hard to get excited other than a micro bet here or there or something that's strategic for a lot of these management teams to get excited about to deploy capital, especially with a higher hurdle to get over today, given their higher implied cost of capital. So I don't expect a lot. I expect more selling and not a lot of buying. Frankly, I'd be surprised if there were any buying.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. In this week's episode, we're taking a close-up look at what we can expect from the lodging and hotel REIT sector going forward with my guest, Michael Bellisario, Senior Research Analyst at Baird. Michael, thanks for joining the podcast today.
Thanks for having me.
So can you describe how the lodging REIT sector started the year coming into 2026 and the outlook more broadly at this point?
I would describe the outlook as somewhat muted. I think it's all relative, though. Last year, 2025, it was a really tough year. Lots of things, some little, some bigger, went wrong for the industry in terms of REVpar, demand, margins. Our outlook, and I think a lot of investors and management teams' outlooks for 2026 is a less bad outlook. We have easier comparisons, and then you add on some special events with the World Cup that should make for a better year. But everyone's cautiously optimistic. There's conservatism in everyone's outlooks. There's lots of little things that could pop up, obviously. We've seen a few things pop up here in recent weeks, but muted. Positive, but muted is the way we thought about it at the beginning of the year, and we still think about it right now.
And you touched on some of those special events coming up in the year. We've also got the 250th anniversary of the US. What do the numbers look like at this point in terms of foreign and domestic travelers planning to participate in those events? And how would you say the lodging sector is preparing?
There are bookings for the World Cup. Rates are up pretty significantly, but it's a small piece, a single-digit percentage in some case that's booked because we're 3 months out. The expectation is that demand will come. Some people think tickets are expensive. We might not have as many people come as maybe even we originally thought in December when we wrote our World Cup note. But in terms of inbound international travel, it's going to be the World Cup. That's the big driver. We estimate 75 plus basis points of REVpar contribution for the year. Most hotel brand and REIT management teams have less than that in their expectations. So we think they're being conservative. We think it will be a pretty significant contributor. But again, it depends. It's still early days. Gas prices will have an impact. Airfare, people haven't booked that necessarily yet. Some of those jet fuel prices get passed through to ticket costs, and it's an expensive trip. So we'll see. But the expectation is when you think about 2025 being a tough year, the baseline is 0 for the World Cup. So we know it's going to be a tailwind. It's just a matter of how much and when do we see those bookings start to pick up. And the expectation is it's probably 60 days out. So 30 days from now is we'll start to see the demand patterns pick up a bit.
And looking at the leisure segment more closely, is it accurate to say that wealthy travelers are really fueling growth at this point?
The luxury chain scale has done significantly better. I think it's important at the lower end chain scales, the economy, mid-scale segments. They've been weak, but they've also been weaker than the underlying trend because of the hurricane lift and benefit that those segments received late 24 into early 25. Those segments were lapping tougher comparisons when you were seeing REVpar growth in those segments down 5, 6, 8% in some cases. That wasn't the true underlying run rate, but the headline would tell you the high end is doing +2, +4, and the low end's doing -4 to -8. It's not quite that wide, but yes, it's the high end is doing better, and there's some wealth effect to that. I'm sure those higher end hotels do have some pricing power, and when you take a step back, you maybe see this. I see this when I travel. Where can hotels raise rate? It's not really in the room. It's out of the room. It's the golf course, the bar, the food and beverage, the meeting space, the banquet and catering, all the non-rooms revenues. So the luxury chain scale for full service hotels are the segmentations that have that. The select service hotels that are primarily rooms only, they don't have those components to their model. So it's a little harder to push rate, which is weighed on REVpar a little bit as well.
And those outer room increases, are they being accepted fairly well by the traveling public?
Well, that's the beauty, right? You book a hotel and I book it based on the rate. I don't know what the drink at the bar costs. And when I'm at the hotel, especially at a resort, The whole point is to keep you captive. So you sort of have to pay what you need to pay to eat and drink. But yeah, people complain about it. You hear about it. I see it as a leisure and business traveler too. Wow, that's $37 for breakfast plus tax plus tip plus fee. The alternative is you don't eat breakfast. But yes, that's where you can pass some of that through at the higher end. And at the lower end, in a lot of the select service hotels, breakfast is free. So that if there is an incremental cost, it's being borne by the hotel owner. It can't be passed through.
And what performance trends are you seeing among business and group? And are there any geographic markets standing out right now?
In terms of geographies first, what we've seen is more of the same. New York has continued to be strong. San Francisco, I wouldn't call it strong, but recovering off of a very low base. So you're seeing good growth in San Francisco. Some of that is conventions have moved back to San Francisco after leaving for a number of years during the pandemic. And then a lot of AI and technology spending has caused a bit of a resurgence in that market. And then Hawaii, particularly Maui, has done better to post fires from now 2.5 years ago. And those markets have been doing better in the back half of 25. They continue to do well year to date. You continue to see the Southeast and Southwest markets where companies are moving, where people are moving, do relatively well, but those growth rates have slowed. So that's the geographic dispersion of performance so far that we've seen.
And how active has the lodging REIT transaction market been lately? And is there any particular capital allocation strategy that companies are following?
The capital allocation strategies is being patient. We've seen that from almost every company. Costs of capital are elevated. That's because stock prices are down. And then taking a step back, the transaction market has been slower. It's picked up a little bit. You're seeing this bifurcation to your prior question on high end versus low end. Recently, we've started to see more luxury, high end, high value hotels transact. Two of those were Host selling 2 Four Seasons properties for over $1 billion. Some of that's because those are the properties where REVpar is going up. So if you're a buyer or you're looking to deploy capital, that's the segment where you can underwrite some growth. It's harder to underwrite growth everywhere else. So you are seeing a bit of a bifurcation where you're seeing some high-end hotels trade at some pretty big prices. And you're still seeing a lot of local owner-operators buying $10, $15, $20 million hotels where they can come in, they'll manage themselves. And the REITs are generally, especially the select service REITs, selling to those groups. So for the hotel REITs, last year, you pretty much had one significant buy, which was Ryman buying from Trinity, the JW Marriott Desert Ridge. Other than that, every other hotel REIT either didn't do anything or sold hotels. Some of the selling is being driven by the balance sheet. CapEx's costs are going up. Interest rates are still elevated. Leverage profiles are still elevated. So there's a little bit of selling assets to fix the balance sheet. I would be surprised if the REITs are buying anything in the first half of 2026 because costs of capital are still elevated. The overly simplistic math doesn't really work. Some of them are buying back stock. They've pared that back a little bit too, but they're being patient. The fundamental outlook isn't robust. Maybe it's 1 or 2% REVpar growth. Expenses are growing 3%. There's not a lot of profit growth in their forecast. So it's hard to get excited other than a micro bet here or there or something that's strategic for a lot of these management teams to get excited about to deploy capital, especially with higher hurdle to get over today, given their higher implied cost of capital. So I don't expect a lot. I expect more selling and not a lot of buying. Frankly, I'd be surprised if there were any buying.
Right. So hotel REITs are not going to hold on to a trophy asset, however perfect it is, if there's a really good opportunity to sell in this market.
Yeah, so you've seen Host sell 2 high-end hotels. I think they were their second and fourth highest total REVpar hotels, at least based on 2024 numbers. Sunstone is looking to sell their 4 Seasons in Napa. I think it will be mixed. Those are, I think, unique cases. I think they're all evaluating what can we do to create shareholder value and not be reliant on industry-wide REVpar growth being very muted and profits being flattish. What can we do on the edges where the public market is perhaps misvaluing an asset? And in a lot of cases, we all value the aggregate. So what's being misvalued is either the high end or the low end. So there is a bit of an arbitrage there. But I do think the host scenario is a little unique in that they didn't need to sell anything. They have an investment grade balance sheet, now sub 3x levered. It was more opportunistic. And I think what's interesting is they're selling those hotels, they're proving value, and they're paying out a special dividend. At least that's the plan right now, to pay out a special dividend. And there's some mixed viewpoints on what they should be doing with that capital. But if there were good, attractive investment opportunities, you would think they would do a 1031 exchange and be wanting to buy or deploying that capital in an acquisition. The fact that they're not tells you they don't see good returns out there and they don't see good opportunities out there. So they're willing to distribute that to shareholders. And they're basically saying, we don't need that capital because we don't have a use for it anytime soon.
And Michael, what about the supply outlook? Any changes expected there?
No, very muted. Sub 1% industry-wide supply growth. I'm call it less than half of what the 35-year long-run average has been. Where you're seeing the supply growth, it's in these lower-end chain scales. So Hilton, Hyatt, Marriott, Choice, Wyndham, all of the brands, IHG, have introduced new either economy or mid-scale conversion or new construction brands over the last couple of years. So we're starting to see more of those open. Secondary, tertiary markets, lots of Southeast, Southwest markets where data centers are being built, for example. It's not really where the REITs own, so you shouldn't see too significant of an impact for them. But it's hard to make, if you're a developer, hard to make the math pencil. Interest rates have come down. Cost increases have moderated. So pricing has stabilized. But it's just hard to put a shovel in the ground or think about underwriting and putting a shovel in the ground 12, 24 months from now, opening 18 plus months thereafter, and trying to get to a 10% unlevered return. There's lots of risks out there, and it's not easy math to pencil. And that's why you're not seeing a lot of supply.
And what strategies are being used by the most successful REITs to maintain and increase occupancy right now?
The big thing is grouping up. So you've seen Ryman, for example, which is predominantly group. They've generally performed better. You've seen Diamond Rock talk about that a lot, employ that strategy in 2025. It sort of always happens when business travel or leisure, basically the transient guest, softens a little bit or the booking window shrinks. They want to build occupancy and they group up. The pie is finite. They're taking share from others, adding some airline crews, but adding group is what they're trying to do. Shrink the hotel, add a bigger base, and then try to price up from there. So you're seeing that across the board. And that's more of a full service strategy, but also the select service REITs are doing that too. They have a lower group exposure, but they're also trying to consciously and intentionally increase their group exposure because, to my prior point, the broader REVpar outlook is a little muted. So build your base of business now and rely less on that last minute business that will come in 1 or 2 weeks ahead of arrival, which is the transient customer.
Excellent. Michael, we've covered lots of ground, but any other trends or themes that you're watching right now?
Yeah, we hit on all of them. Sort of an offshoot of transactions is just M&A. We always get questions about that. Braemar has publicly announced that they're exploring strategic alternatives. I think there's a view among investors that with the hotel REITs trading at discounts to NAV, constrained from a capital allocation and investment perspective. Question is, why aren't more of these companies or management teams looking to sell themselves? And I think they all are. They're evaluating it. There's lots of private capital on the sidelines, the debt markets, pricing and availability. It's attractive. There's still a bid-ask spread, and the math doesn't really pencil because very few private guys are willing to make a big macro bet on a 30, 50, 80 hotel portfolio, but sort of an offshoot of transactions. Investors, our public market investors, are asking about that more often recently.
Great. Michael, thanks so much for your time today.
Thank you for having me.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.